Now, China's record iron ore imports are likely to slow in the second half of the year, but is that an indication of slowing growth on the mainland? Bloomberg's Stephen Angle is on top of the story. Steve.
Yeah, Haslin, I'm going to get to that in just a sec. Just because we've had the volatility in the local stock market, I want to get to an update there. We are seeing a slight rebound in the opening minutes of the Shanghai Composite Index. It is up about 1.1%. Shenzhen marginally higher, about 0.25%. Blue chips leading the way. Energy and banks. PetroChina up 2.3%. ICBC up 1.3%. We had been making note all morning of Merrill Lynch coming out in a note to clients saying that this is not necessarily the start of a bear market. It won't last. China stocks will rebound. I don't think this is a turning point, according to David Cui, the China strategist at Merrill Lynch. Maybe that helping give a little bit of a lift to the market. It needs it, of course, as Linda, as you know, we've seen a big sell-off yesterday, 4.3% plunge, another 5.8% down on Monday. The benchmark index has fallen 20% since its year high on August 4th. So stay tuned today. See if it can maintain that for the course of the day. All right, back to the iron ore story. Benchmark steel prices, Haslinda, in China last week had their first decline in 6 weeks, while also the Baltic Dry Index, which measures shipping costs, has slumped 22% this month after that big run-up in the first half. This on speculation that China's demand for imported iron ore may indeed be slowing. The steel index price has risen 46% this year as the Chinese government stimulus plan spurred domestic demand. But analysts say iron ore prices may have now topped out after China imported a record level of iron ore in July, China stocking up while shipping rates were lower in the first half of the year.
In
the second half of this year, the quantity of imported iron ore will be less than in the first half. That is not a reflection of a drop-off in factory production, but due to the higher seaborne freight rates. Iron ore imports surged in the first half because of the low cost of transport, but we started seeing rates rise in the second quarter. Domestic steelmakers are now preferring to use local iron ore rather than the imported one. We'll see the decrease in imports reflected in September and October statistics.
There's a bit of a lag effect there with those statistics. Now, one can see where the Chinese took advantage of the lower shipping rates in the first half of the year at a time when infrastructure spending was just about to kick in as a result of the government's $585 billion stimulus measures. And even though iron ore imports may lag in the coming months through the second half of the year, fixed asset urban investment and industrial production figures in China so far have remained pretty steady. And analysts expect if there is going to be weakness, it will be mild.
China's steel industry has ramped up significantly over the last 6 months, a lot of it driven by anticipated demand for infrastructure and also for the property sector. And what we're seeing in the macro data is that that investment is actually following through, and we expect demand for steel, particularly in China, but outside as well, to pick up. So iron ore demand will be very strong.
Grow. So there's not going to be a slowdown in growth for either vehicles or steel in China in the balance of the year or the foreseeable future. It's just that the rate of growth may moderate over time. So there's going to be continued growth for steel. There's going to be continued growth for vehicle production, vehicle sales in China.
A positive outlook from General Motors in China there, Haslinda. It's yet to be seen how stalled contract talks with iron ore suppliers in Australia will affect long-term demand, though, from China for Australian iron ore, as China perhaps looks elsewhere, India, Brazil, to meet its demands. Haslinda?
Hey, there's been a bit of a war going on with iron ore prices. What's going on? What's the fallout?
Yeah, you can that's putting it mildly, yes. BHP Billiton, Rio Tinto, Vale as well control about 2/3 of the world's seaborne supply of iron ore, half of which is shipped to China. And Rio Tinto leading these stalled annual iron ore contract talks, still deadlocked after 4 months. The Chinese have been paying sky-high spot prices in the meantime, which have soared nearly 50% this year. It's one reason the Chinese sealed a deal with Australia's third-largest iron ore producer, Fortescue, FMG, slashing contract prices with its Chinese customers by 35% in exchange for financing from Chinese lenders.
We've broken the back of this supply stranglehold through building our own railway lines, our own ports, our own mines. But is it big enough for the people of China? It certainly isn't. China has excellent sources of capital. We have excellent sources of iron ore. We marry those two, the big winners here are the people of China.
And Haslinda, China may be seeking other similar deals with other iron ore suppliers to get around what Forrest there just called a stranglehold on the iron ore trade by the big three. Back over to you.
And you know what they say, watch that space.